Imagine sitting in front of your monitor, watching the Bitcoin chart. The candles flash red and green, the numbers change every second, and you think you're witnessing the free market in its purest form. The struggle between supply and demand. But what if I told you that behind these chaotic movements lies the invisible hand of the very institutions Bitcoin was created to counter? Do you think banks are afraid of crypto? Oh no, they've found the perfect playground. There's a hidden loophole that the largest financial institutions are exploiting right now to manipulate the price, squeeze your coins out of your hands, and make billions off of your fear. Bitcoin was conceived as a bank killer, a way to escape a system where the printing press was everything. But banks aren't just buildings with vaults. They're massive computing and analytical machines that have spent decades honing their skills in manipulating gold, oil, and currency markets. When they realized Bitcoin wasn't going anywhere, they didn't destroy it. They decided to lead it using the paper Bitcoin method. Here's the crux of the loophole. You don't have to own the asset itself to influence its price. In traditional finance, this is called derivatives. Banks have created an endless ocean of futures, options, and ETFs that allow them to trade the promise of Bitcoin, not the coin itself. Imagine you own a gold bar. If I start selling millions of pieces of paper saying, this piece of paper equals a gold bar, the price of your real gold will fall because the market is flooded with supply. Banks do the same with crypto. They flood the market with virtual coins that don't exist on the blockchain, artificially suppressing the price just when they need to buy cheap. But why do they need this? The answer is simple: to control volatility. For banks, Bitcoin isn't digital gold, but the perfect tool for extracting liquidity. They use algorithms that detect your stop losses. Did you place a sell order if the price drops to 60,000? They know it. Using leverage and massive paper supply, they momentarily crash the price, trigger your millions of stop losses, take your coins for next to nothing, and immediately push the price back up. You're left with nothing, and the bank just replenished its reserves. The most cynical part of this scheme is that they use your own money against you. When you deposit dollars or invest in banking products, those funds become fuel for their trading desks. They use your liquidity to build positions that collapse the crypto market you so strongly believe in. It's a vicious cycle. You work for the system takes your money and manipulates the future of your investments. This loophole is legal. It's built into the rules of exchanges and regulators. While you're waiting for the moon and believing in decentralization, the algorithms of major investment banks execute thousands of trades per second, creating false trends and bull traps. They force you to buy at the peak using positive news from the media they themselves sponsor, and then close their huge positions on you, causing panic. You must understand, Bitcoin in your app and Bitcoin in the hands of a bank trader are two different beasts. One is a symbol of freedom, the other is a lever for controlling the masses. Banks use volatility not as a risk, but as a product. They don't care whether Bitcoin is worth 100,000 or 10,000. They care that you make mistakes along the way. To understand the full depth of this rabbit hole, you need to understand the concept of rehypothecation. In traditional banking, you deposit $1, the bank keeps 10 cents, and rents out the remaining 90. In the world of Bitcoin, where the total supply of coins is strictly limited to 21 million, this scheme should have died. But banks found a loophole. They created a system where the same real Bitcoin stored in their vault can be promised to 10 different investors simultaneously. Imagine buying Bitcoin through a major financial app or fund. You see the numbers on the screen, you feel like you own the future. But in reality, the bank could be using this asset as collateral for its own risky operations. They lease your ownership to short sellers, the very people betting on Bitcoin's decline. So, you pay the bank a fee for storage, and the bank uses your asset to help other players drive down its price. This is financial cuckoldry at its purest, where you're paying for the instruments of your own ruin. Banks manipulate prices through so-called liquidity pools and over-the-counter OTC trades. When a major bank wants to buy $1 billion worth of Bitcoin, they don't do it on a public exchange, where the price would immediately skyrocket. No, they execute the trades directly, bypassing the charts you see on your phone. But when they need to sell, they go public, creating massive pressure and panic among retail investors. They buy quietly and sell with a bang, and this is where the psychology of price walls comes into play. Have you ever seen a huge sell order on a chart that simply won't let the price rise above a certain level? These are often phantom orders placed by the bank's algorithms. They don't need to sell these coins. They need to scare you into thinking, oh my God, there's too much resistance here. Time to get out. As soon as you and thousands of others like you sell your shares, the wall instantly disappears. The bank simply canceled the order. It didn't spend a cent, but it forced the market to bend to its will. It's a game of poker where the bank sees not only its own cards, but also your reflection in the mirror behind you. Thanks to modern data tracking technologies, banks know the average entry price of most retail traders. If they see that a huge crowd has bought Bitcoin at 65,000 and most of them have no margin of safety, they will methodically push the price down to 58,000 to trigger a cascade of forced liquidations. This is called liquidity hunting. For them, this isn't investing, it's harvesting. Institutional players also exploit a reporting loophole. Cryptocurrencies allow them to move huge amounts of capital at incredible speed, which is ideal for drawing the necessary reports at the end of the quarter. They can temporarily inflate the price of crypto assets on their balance sheets to show profits to shareholders, only to crash the market the next day by opening short positions. This is a legalized mechanism for capital manipulation that won't be covered in economics textbooks. Your main misconception is that you think Bitcoin is tamper-proof because of its code. Yes, the blockchain code is immutable, but the interface through which 99% of people interact with Bitcoin, exchanges, wallets, ETFs, is completely controlled by the same banking infrastructure. You don't own your keys if you buy paper Bitcoin. You own a receipt worth exactly what the bank is willing to pay you in a crisis. And history teaches us that in a real crisis, banks always choose themselves, not you. They've created a Wild West aura around crypto to justify the introduction of strict regulation. But the irony is that this regulation is dictated by those same banks. They're creating gated gardens, licensed platforms where trading is conducted according to their rules, with their fees, and under their complete oversight. The loophole closes for you, but widens for them. The most dangerous thing about this game is how banks use information noise to manipulate volatility. Have you ever noticed how suddenly major media outlets start publishing headlines about Bitcoin being a bubble or a criminal tool? 90% of the time, this happens right when the bank's algorithms have finished allocating their positions and are ready for a major dump. They create an emotional background, so you hit the sell button precisely when they need to close their short positions out of fear. But there's also a flip side, the bull trap. Banks sponsor analyst reports predicting a $200,000 price by the end of the month. They create a sense of missing out, FOMO. You see the price rise 5 to 10% out of nowhere and jump in at the very peak. At that point, the banks exploit a liquidity loophole. They sell you the coins they've accumulated at the bottom, using your enthusiasm as exit liquidity. The price freezes and then plummets, leaving you holding the bag with losses for months. Another hidden mechanism is influence through stablecoins. Most people think of stablecoins as simply digital dollars. But who is behind the largest issuers of these coins? Those same banks and financial giants. Using stablecoins, they can create artificial demand. If they need to boost the price of Bitcoin, they can literally print digital securities out of thin air, inject them into the market, drive up the price, and then extract real dollars when retail investors buy into the hype. It's a scheme for endless money printing, transferred to the digital world, where there's not even the minimal oversight that exists at the Fed. You must understand, for banks, Bitcoin is the perfect arbitrage tool. Thanks to their connections and access to ultra-fast communication channels, they see price differences on exchanges in Tokyo, London, and New York milliseconds before you do. By exploiting a loophole in order execution speed, they take a micro profit from every trade you make. This is a tax on your slowness, which, when scaled up by $1 trillion market, translates into colossal profits, siphoned out of the pockets of ordinary people. But why do all this when they could simply ban crypto? Because Bitcoin is the best mechanism in history for absorbing excess liquidity. In a world where too much fiat money is printed, banks need a reservoir into which this money can flow without causing hyperinflation in the food and housing markets. Bitcoin has become that reservoir. Banks allow the price to rise to burn the excess money supply and then collapse it, destroying the capital of millions of people and effectively removing this money from circulation. It's a global mechanism for sterilizing the economy, where you are a willing participant sacrificing your savings for the stability of their system. The loophole we're talking about is that banks have transformed Bitcoin from decentralized money into a decentralized casino, where they own all the tables, all the cards, and even the air you breathe. They use the blockchain's transparency against you. While they previously didn't know how much money you had in your wallet, now, if your address is linked to an exchange account, they see your every move. They analyze the behavior of whales and plankton, creating models that predict mass panic with hourly accuracy. Your faith in diamond hands and long-term investing is also part of their plan. While you hold onto your coins for years without selling, you create a supply shortage, which allows them to manipulate the price more easily with small amounts. You are a willing custodian of their asset, ensuring the stability of the foundation on which they build their speculative towers. And when the time comes for the final blow, they will use their ETF positions to seize control of the Bitcoin protocol itself through pressure on miners and developers. This isn't a conspiracy theory, it's the cold mathematics of capitalism. If an asset poses a threat to the system either destroys it or absorbs it. Bitcoin was absorbed the moment the first major bank opened its cryptocurrency desk. Now it's their game. You're a guest at this feast of life, and your job is to avoid becoming the main course on their table. Banks also exploit a loophole called front-running liquidity, made possible by the emergence of institutional ETFs. When you buy shares in a Bitcoin fund, you think you're simply investing in crypto through a user-friendly interface. But in reality, you're creating a predictable capital flow that banks see hours before it actually hits the market. They know how much they'll need to buy to secure the fund at the end of the trading session, and they open positions in their private accounts in advance, forcing you to buy at a slightly higher price, which they themselves created 15 minutes earlier. Moreover, there's a phenomenon called digital runs. In the traditional banking system, if a bank goes bankrupt, the government can print money to bail out depositors. In the world of Bitcoin, this is not an option. Banks exploit this severe supply constraint to drive the price into a corner. Using hidden algorithms, they create periods of artificially low volatility, where the price moves within a narrow corridor for months. This wears down the retail investor. You become bored, you lose faith, you start to think Bitcoin is dead. And once a critical mass of ordinary people exit the asset, recording losses or zero profits, the banks let go of the leash, and the price soars 20% overnight. It's a psychological war of attrition, where their main resource is endless patience, backed by other people's money. We shouldn't forget about the loophole through mining pools. Today, mining isn't just a guy with a graphics card in his garage. It's massive data centers that require colossal loans to purchase equipment and pay for electricity. Who issues these loans? Major investment banks. By setting the terms of the loans, banks gain indirect control over when miners sell their mined coins. They can force miners to dump Bitcoin on the market during periods of low liquidity to exacerbate the price decline, or, conversely, allow them to hold on to coins to create a shortage. Miners have become foot soldiers in the bank's financial army, often without even realizing it. Banks also exploit a loophole in the blockchain's transparency. There are specialized analytics companies, closely tied to the banking sector, that label every Bitcoin on the network. If your coin has ever passed through a mixer or the wrong wallet, the bank can block it from being accepted on an exchange or demand derogatory proof of origin. This creates a divide between clean, bank-owned Bitcoins and dirty, unowned Bitcoins. Clean coins trade at a premium, while dirty ones trade at a discount. Thus, banks create a caste system within Bitcoin, where only their approved assets have full market value. This strikes directly at the heart of the idea of fungibility. And here's the most shocking element: the use of credit default swaps on crypto assets. Banks insure their positions with each other, creating a complex web of liabilities that makes them too big to fail, even in crypto. If the Bitcoin market crashes by 90%, the banks won't suffer, as their losses are covered by insurance and short positions. The only one who suffers is you. They've turned Bitcoin into a hedge against their own risks in the traditional economy. For them, it's not an asset of the future, but just another column in an Excel spreadsheet designed to balance their risks in real estate or government bonds. This hidden loop of manipulation tightens with each passing year. The more Bitcoin becomes legal and accepted on Wall Street, the less it retains of the original code of freedom Satoshi wrote. Banks aren't fighting Bitcoin, they're colonizing it. They're building their railroads over its open fields and setting up their customs posts at every exit. What can you do? First and foremost, stop playing their game on their terms. If your coins are sitting on an exchange or in a bank app, they're not your coins. They're their weapon against you. The real way out of this loop is cold storage, refusing to trade on volatility, which they control, and understanding that every time you give in to emotions, you're simply transferring your life force to an account at a major bank. The banking system has survived for centuries, adapting to every threat. Bitcoin is their greatest challenge, but also their greatest opportunity. They exploit loopholes in psychology, technology, and the law to ensure that the house always wins in the end. Now that you see these mechanisms, you can no longer say you didn't know. Your only chance is to break away from the herd being led to the slaughter and start thinking in terms of decades, not 5-minute charts. The system is powerful, but it is powerless against those who understand the rules and refuse to play it. Let's examine a technique banks call wash trading on steroids. It's illegal in the regular world, but in the murky waters of the crypto market, where regulation is just beginning to take its first steps, it's a key tool for creating false trends. Banks use a network of shell offshore companies and sub-accounts that trade themselves. You see a huge spike in trading volume on the chart and think, wow, a big buyer has entered the market, time to jump in. But in reality, not a single Satoshi has changed hands. The bank simply shifted coins from its left pocket to its right, creating the illusion of life where there is none. You buy on this fake impulse, and as soon as the bank sees a sufficient number of real retail orders, it simply stops faking activity and the price plummets. You bought air at the price of gold simply because the bank painted you a pretty picture on the chart, but that's just the tip of the iceberg. The real magic happens in the realm of HFT arbitrage, high-frequency trading. Bank servers are physically located in the same data centers as the servers of the largest crypto exchanges. The difference in signal speed between you and the bank is mere microseconds. But in the world of big money, that's enough to rip you off with every trade. When you click buy, your signal travels through internet providers, and the banking algorithm already sees your order in the queue. It manages to buy Bitcoin for a fraction of a cent cheaper and resell it to you in the same microsecond. You're paying a hidden tax without even realizing it. On the scale of millions of trades, banks are siphoning billions of dollars out of the market simply by exploiting a loophole in the laws of physics and network infrastructure. Now imagine the power of synthetic assets. Banks create tokens that are supposedly pegged to the price of Bitcoin, but have no real backing in the blockchain. These are financial derivatives that allow them to endlessly inflate the supply. If demand for Bitcoin grows, instead of buying the real coin and driving the price up, banks offer investors synthetics. It's like if you went to buy bread and were sold a piece of paper with bread written on it, promising that its price would rise just like the price of a loaf. Demand is satisfied, but the price of real Bitcoin remains unchanged because not a single transaction has occurred on the blockchain. This is the perfect way to suppress the price of an asset, creating an endless virtual clone that absorbs all the capital of newcomers. Let's move on to the darkest part, credit loops. Banks issue huge loans to crypto exchanges secured by their own tokens or reserves. This creates a situation of mutual destruction. If the price of Bitcoin falls to a certain level, the bank has the right to demand immediate repayment of the loan. To avoid bankruptcy, the exchange is forced to launch a massive sell-off of its clients' Bitcoin to raise cash dollars to pay the bank. This creates an artificial crash, which the banks call a cascading liquidation. They themselves provoke the crash, force the exchanges to sell, and then buy back these coins at the very bottom for next to nothing. This isn't a market, it's a controlled demolition of a building, where the banks are the architects and you're a random passerby on whom a brick falls. Banks are also exploiting a loophole in mining derivatives. They buy future hash rate mining power from major companies for years to come. This gives them a say in which updates are adopted on the Bitcoin network. You thought Bitcoin was decentralized? Look who's funding the developers of the core protocols. Huge grants from foundations backed by those same banking institutions are being channeled into changes that make Bitcoin more easily controlled by institutions and less anonymous for you. They don't break the code, they buy the people who write it. This is soft power, turning a revolutionary tool into just another banking product with a pretty wrapper. Another hidden strategy is index manipulation. Dozens of crypto indices are currently being created. including Bitcoin and several altcoins. Banks manipulate the price of the weakest asset in the index to trigger a movement of the entire index. It's like pulling one string to make the entire puppet dance. Retail investors see that the index is falling and start selling Bitcoin, even though nothing fundamentally has changed. This is a psychological game of association, where banks exploit the complexity of financial instruments to confuse the average person. Banks are also masterfully exploiting a loophole called regulatory strangulation. Have you ever wondered why large financial institutions have suddenly become the main lobbyists for crypto legislation? They're not trying to protect you. Their goal is to create such a high barrier to entry for any independent players that only banks can legally manage your digital assets. Imagine access to Bitcoin being restricted to certified custodians. This means you can no longer simply transfer coins to a friend. You must get approval from a compliance officer who will check every comma in your background. Banks are transforming Bitcoin from an open protocol into a closed database, where they are the sole gatekeepers. But let's move on to the mechanics of price clamping. This is when banks use their positions in the bond and stock markets to manipulate the Bitcoin price through correlation. They know that most trading bots are set up to buy Bitcoin when the S&P 500 rises and sell it when it falls. Banks with trillions of dollars in capital can artificially depress the S&P 500 for a few hours, simply to trigger an algorithmic sell-off in Bitcoin. While bots and panicked traders dump crypto, banks buy it back on the over-the-counter markets. This is intermarket arbitrage, where Bitcoin is used as a pawn in a larger stock market play. The next loophole is hidden issuance through wrapped tokens. You see tokens called WBTC, wrapped Bitcoin, on the Ethereum or Solana blockchain. You're told that each token is backed by real Bitcoin in a vault. But who controls this vault? Often, it's consortiums that include the largest financial players. There's no real-time transparency in this system. A bank might issue 1,100 wrapped Bitcoins while only having 1,000 in reserve. These extra 100 coins are dumped onto the market, putting downward pressure on the price. And when it's time to audit, the bank simply borrows the rest from another bank overnight. It's the same fractional reserve system that led to the collapse of traditional banks, but now it's been ported to crypto under the guise of innovation. Let's talk about dark pools. These are closed trading venues where banks and institutions trade massive volumes of Bitcoin, bypassing public exchanges. When a bank wants to unload a position, it does so in a dark pool to avoid crashing the price prematurely. But as soon as the trade is completed, they issue a report on the negative market outlook, triggering retail investors to sell. You see a crash on Binance or Coinbase and think the market is falling on its own. In reality, you're simply observing the echo of a trade that occurred in a dark pool 3 hours earlier. Banks are always one step ahead because they see real capital flows while you're looking at lagging candlesticks on charts. Another sophisticated method is managing network difficulty through lending to miners. Mining requires enormous energy costs. Banks offer miners lines of credit, with equipment or future mining as collateral. If the bank wants the Bitcoin price to fall, it can demand early repayment of part of the loan. A miner with no available cash is forced to immediately sell their mined Bitcoins. This creates artificial supply at the most inopportune moment. In essence, banks have turned miners into their puppets, who press the sell button at the first call from the credit department. Don't forget about information terrorism. Banks have departments dedicated to sentiment analysis. They use botnets on Twitter, X, and Reddit to amplify certain narratives. If they need to buy, the bots start posting messages en masse about code vulnerabilities or an upcoming ban in China. This creates a micro-panic. You can be the most steadfast investor, but when everyone is shouting about a collapse, your hand involuntarily reaches for the sell button. At that moment, the bank's algorithm places thousands of tiny buy orders, which quietly absorb your fear. The tax loss harvesting loophole is another form of manipulation. At the end of the financial year, large funds and banks sell crypto assets en masse to lock in paper losses and reduce taxes on profits from other investments. This causes the annual December crashes. They know you're scared, and they use this period to reset their positions. In January, the same money returns to the market, causing a sharp rise. They profit from taxes, they profit from exchange rate differences, and you're left wondering why the market is behaving so irrationally. Banks also exploit a loophole in stablecoin liquidity. They know that most trading pairs on exchanges are Bitcoin versus USDT or USDC. By controlling the bank accounts that hold the real dollars backing these stablecoins, banks can create withdrawal issues or initiate an investigation against the stablecoin issuer at any time. A single rumor that the largest stablecoin is unbacked can cause Bitcoin to plummet by 30% in an hour. This is a nuclear button that banks keep handy to discipline the market at any moment if it begins to slip out of their control. The final and most carefully guarded loophole is coordinated sterilization of capital. At the highest level, behind the scenes at the Bank for International Settlements, BIS, the crypto market is perceived not as a threat, but as a global vacuum cleaner for excess money. When the Fed and ECB's printing presses overheat, creating the risk of hyperinflation, the banks need a place where people can voluntarily send their trillions of dollars, preventing them from going into the food or housing markets. Bitcoin is the perfect candidate. They allow the market to grow, inflating the bubble to incredible proportions, and then, when inflationary pressure in the real economy peaks, they pull the levers we discussed earlier. A crypto winter occurs. Billions of dollars in market capitalization simply evaporate. This isn't just a price drop, it's a controlled destruction of the money supply, where your savings are burned in a furnace to preserve the stability of the dollar. But there's a more dire scenario. Operation Last Exit. Banks know that trust in fiat currencies is waning. They're laying the groundwork for a transition to a new system, with Bitcoin playing the role of a Trojan horse. Using a loophole in international law, they're gradually converting their gold reserves into a digital equivalent, using shell funds to avoid panic. When the process is complete, they'll trigger a global financial crisis that will make 2008 look like a breeze. At that point, they'll declare Bitcoin the only legal standard of value, but by then, 80% of all coins will already be sitting in the vaults of the world's 5 largest banks. You'll find yourself in a world where Bitcoin has won, but you're still a pauper, because your coins were shaken out of you during yet another planned 80% correction. The most sophisticated psychological loophole is the illusion of opposition. Banks deliberately create the appearance of a struggle. They allow certain media personalities and crypto anarchists to loudly proclaim the end of the banking era. This lulls your vigilance. You think, if they're arguing so loudly, then I'm on the right side. In reality, this rhetoric is just noise, designed to hide the fact that Bitcoin's infrastructure has long since merged with that of banking. Every time you use a convenient biometric wallet or buy crypto through a banking app, you voluntarily put yourself in digital shackles that the bank will snap into place at the right moment. The final step of their manipulation is inheritance takeover. Banks are implementing laws that make it virtually impossible to legally transfer Bitcoins to heirs without the involvement of a licensed financial intermediary. If you keep your keys on a piece of paper, your heirs may face such taxes and legal barriers that they'll be more comfortable handing those coins over to the bank for next to nothing. They're playing the long game. If they can't take your Bitcoin now, they'll take it from your children, creating a system where off-system crypto ownership is equated with possession of contraband. Now you see the whole picture. This isn't just charts, it's not just technology, and it's not just digital gold. This is the greatest chess game in human history, where the pieces are your ambitions, your fears, and your hope for freedom. Banks are exploiting loopholes in code, in the law, in the economy, and in your own mind to ensure that the new era of money will be as much theirs as the old one. Bitcoin may be decentralized, but the world it inhabits remains hierarchical. Your only path to salvation is to become invisible to their algorithms. Don't keep everything in one place. Don't believe the official narratives. Don't let them dictate when to fear and when to rejoice. Your true value isn't the numbers on a screen, but your ability to understand how these mechanisms work and make decisions that defy the system's pressures. Banks will always try to manipulate prices, because price is their primary tool for controlling your attention. But they can't manipulate your awareness. Now that this loophole has been exposed, the noose can no longer tighten undetected. You're forewarned, you're armed with knowledge, and in this casino of the future, that's the only advantage you truly have left. The game goes on, but now you know who's really dealing the cards. And remember, in a world where banks use Bitcoin for control, owning your own information becomes your most valuable asset. Be vigilant, be free, and never let them convince you that you've already won. The real fight for your financial independence is just beginning.